This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. This is Jonah Lupton. Welcome back to the Investing with the Whales podcast. I think you all know my next guest. It is Puru Saxena from Hong Kong. Twitter is a very popular guy on Twitter that we all follow and enjoy his commentary and whatnot. So let's just jump in. Puru, what are your thoughts right now on the overall markets? Are you bullish, bearish, somewhere in the middle? And then explain why.
For sure. Thanks for having me back on your podcast show. I think, Jonah, the stock market has been pretty bifurcated. If you look at the last 6-7 months or so, it has been one of the most challenging tapes I've seen, and I've been doing this for 20 plus years. We had the first waterfall decline in all stocks in 2022, which basically culminated in the S&P bottoming out in October for now. And then we had the bottom in November, like a double test of the lows in late December, early January by the NASDAQ. Some of the growth stocks bottomed out in May, June last year, and they've been consolidating for almost a year. Some have started breaking out to the upside already. So this has not been a uniform tape at all. It's been all over the place, and sectors have been, moving in and out. There's been massive sector rotation, style factors and all, what have you. So it has not been a bear market where everything has moved together, and that is quite rare. That doesn't normally happen. Normally, all sort of stocks move up and down in bear markets together. So it's been very challenging, and also, I think, the first leg down in 2022 was primarily due to the rapid increase in long-term interest rates. So the discount rate went up like several 100% very quickly. And valuations, as you know, were very stretched in 2021. I actually warned about the coming bust. I did not foresee the magnitude of the bust, but I knew very clearly that the bull market was ending in late 2021. I did a podcast with Dave Lee where I mentioned, the bull market was probably ending. And I got a lot of criticism and hate back then saying, you have no idea, you just, an old timer, you don't know, and all that kind of stuff. So, that's all fine. So we had the first big leg down in 2022. And then the liquidity started expanding. So, the balance sheets started going up again. Bank of England intervened, if you recall, last autumn with their gilt crisis. And then they basically printed money or reserves. And then you had more intervention recently in the aftermath of the bank failures in the US. The Fed's balance sheet went up a lot. Admittedly, that's not QE, but they did actually print dollars and added to the reserves. And that again helped asset prices in the near term. My view is that we are likely headed towards a hard landing in the US. The data is screaming recession. If you look at the leading indicators have been screaming recession for the past several months. The yield curve is severely inverted. The banks' lending standards have been tightening. If you look at the loan surveys and stuff which have just been reported today,
right.
They're showing that 46% of the banks are basically tightening their credit standards and lending standards. And if you also look at the commercial banks in the US, the deposit base is in contraction. The money supply is contracting year over year. So all these indicators are suggesting that the US is headed towards a hard landing later this year. The coincident and lagging data is not showing that yet. So if you look at the unemployment rate, that just hit a new low. And everyone is saying, oh, look, there is no recession. There is a soft landing. Everything is fine. But I would like to remind everybody that the jobs data is one of the most lagging indicators and data points out there. By definition, the jobs market has historically been very strong heading into every single recession. So I wouldn't, take that as the gospel that, everything is fine. I still think we are going to see problems in the economy, perhaps in 2 or 3 months from now. My base case still is that there is going to be a recession in the US, probably somewhere around August, September time, give or take. And I don't think the indices have sort of discounted that already. I may be wrong, there are no guarantees in this business, but I don't think that the indices have discounted that already, especially a severe recession. If you look at, the growth stocks, which you and I invest in and we track, they've already been bombed, they've already crashed and burned, they're down 80, 90, 95%, some of them. So I would argue that they have already discounted a lot of the problems and the valuations are now pretty compelling. And if we do get into a recessionary scenario, I think long-term interest rates are going to go down. The Fed will cut rates aggressively, and that's going to be a tailwind for these long-duration assets, which have already basically been taken to the woodshed. So I own shares in software, e-commerce, and fintech payments companies, EVs, and so forth. I'm also actively, shorting the Russell 2000 index futures, RTY, as a hedge in the portfolio.
Why do you short the futures rather than just the underlying ETF like an IWM or IWO?
You could do either. I have the capability of buying and selling futures in my account, so I just find it easier to short the futures because they trade 24/7, Monday to Friday. So I just find it easier, but anybody can do either. So I'm actually betting that the economically sensitive sectors of the economy, like the banks and the IWM and so forth, those companies are likely to sort of feel the pain more in a recession than these high growth, secular growth names, which I invest in.
Because even though the SPY and the QQQ are doing decent year to date, the QQQs are doing better. Those are the market cap weighted indexes, whereas the equal cap weighted indexes are doing much worse. So is that, I know last year you were ahead of the curve saying that, the generals are the last ones to get shot. We've seen the generals bounce back, once Meta did their cost cutting, lowered their CapEx, big headcount reduction. You saw, Meta spike, NVIDIA's come roaring back because of their AI push. Microsoft, really never fell too hard. Apple didn't fall too hard. But it seems like that's where all the money's going. Everyone's hiding out in these generals and the valuations feel sort of stretched. Do you think do they need to get shot again?
Well, it depends on how bad the recession is. If earnings fall off a cliff and you have a real hard landing in the US, which I wouldn't rule out at this stage, by the way, it is conceivable that these names will also come down quite significantly because we are now in that phase, this Goldilocks phase, where the Fed is apparently done, or the Fed is pretty much done at this point. They may raise rates another 25 basis points, but that's a very high hurdle to jump over. So by all practical purposes, if the Fed is done, the market is now celebrating the end of the monetary tightening, and the economy hasn't started really significantly weakening yet. So we are in that honeymoon period where the Fed has actually done its thing and the economy still looks pretty strong. But, as you know, that monetary policy works with a lag.
Right. There's a 6 to 12 month lag effect on rate hikes, right?
Correct, 12 to 18 months in some cases. And also, don't forget, we've had these stimulus checks, which were sent by the US government, helicopter money, which was financed by the Federal Reserve doing QE. And all that money is still basically sitting with, not all of it, but a lot of it is still sitting with American households. So I looked at some data from JP Morgan, and it says that the US households are now basically burning $120 billion a month from those stimulus checks and savings. And at that rate, these excess savings are likely to disappear within 5 or 6 months. And I think that's when you will start to feel the real impact of the ongoing monetary tightening and the tight monetary conditions, because the free money which was sent by Mr. Biden during the pandemic is going to disappear. And also the lags of the monetary policy will become more evident in 2 or 3, 4 months from now.
I'm in the camp right now that we're not going to have a recession unless we see severe disruption in the credit markets. We see unemployment rate going up. But those are two things that could certainly happen. Like you said, you have 500 basis points of rate hikes. You have the credit tightening from the bank failures, right? I mean, loan volumes are way down. Banks aren't, especially regional banks don't want to be giving out money right now because, their balance sheets are already in turmoil. And then you have the Fed going back to QT as soon as they can. So, I mean, you would think that those three things combined are going to slow down the economy dramatically. What other landmines are out there? When could commercial real estate, rear its ugly head and cause another problem for some of these regional banks?
Well, commercial real estate is already deflating, and I don't think this is the end. I think this is the beginning. Housing basically goes up and down more slowly than equities, which are very volatile. So typically, the real estate cycle can go on for 2 or 3 years, especially in a downturn. So I think we are sort of somewhere in the early to mid stages of the deflation in the commercial real estate market. And the regional banks, Jonah, have got a huge amount of exposure to commercial real estate loans. And I think that is a concern. And the Fed's policy is not helping matters either, because if you see what the Fed has done, the Fed has basically jacked up the Fed funds rate to about 525 basis points. And what did the Fed recently do? It increased the FFR further by 25 basis points. The yields which are available to depositors in banks in the US are tiny compared to what you can make from treasury bills these days. So it's hardly surprising that, there is a deposit flight, capital flight going on in the regional banks where people are just saying, get me out. I would rather own T-bills and make 450, 500 basis points yields rather than keeping my cash in your bank and getting paid very little. So these are some of the concerns. And historically, this time may well be different. There is nothing guaranteed in this business, but 100 years of history suggests that we have not yet seen the full impact of the ongoing monetary tightening in the US. And also, if you look at the quantitative tightening, Jonah, the quantitative tightening never stopped. It is still going on. So the Fed's balance sheet briefly popped up because of all the loans which it extended to the banks. But the balance sheet is now again coming down quite rapidly. And the Fed is still, shrinking its balance sheet every single month. So these are headwinds for stocks. My best guess is that, equities may chop around these levels, especially the indices. But we are likely to see some turmoil in the back half of this year. My timing has been off this year, so I'm not the best person to listen to. Everybody goes through good patches and bad patches, and my timing has been pretty off for the last few months as far as the stock market is concerned. So,
I mean, you're not alone. I mean, I saw a stat the other day that I think it's hedge funds are positioned as bearish as they have been since March 2020. And before that, the last time was the great financial crisis, I think 2007 or 2008. So, the smart money is betting against the markets right now and betting on a recession, economic recession, which I suppose leads to an earnings recession. And if you have an earnings recession, then multiples have to come down. Right now the S&P is trading at probably 18.5 or 19 times this year's earnings. If SPY or SPX does 220 in earnings, I've seen some people saying that we're going to have an earnings recession and next year we'll do 200. And I've seen some people say that we're going to have a soft landing, no earnings recession, and next year we do 240 or 250. So, I mean, people are all over the place with this stuff. But I mean, what have you seen just historically? If we get an economic recession, does that typically lead to an earnings recession as well?
Correct. If you look at all the recessions going back 50, 60, 70 years, in an inflationary recession like now where you have high inflation, earnings have gone down 15 to 20%, which is a big decline when you consider inflation. In some of the recessions, earnings have come off 30, 40, 50%. Now, I'm in the camp that we are going to see at least a moderate recession. It could be worse. So it would be most unusual if equities sort of stayed here, didn't react to the decline in earnings later this year. But anything can happen. I've been wrong before, long as has any other investor and trader on the planet. But 100 years of history suggests that earnings are likely to deteriorate quite meaningfully over the next 12 months or so, unless this time is different.
And once you get an earnings recession, where would multiples on the S&P typically bottom out? I mean, we're talking, what, 13, 14?
Probably, 14, 15 forward P. If we do get a hard landing in the US later this year and earnings, surprise to the downside, and, you have credit spreads blowing out and you see credit problems, which are typically seen in every single cycle, I don't really see why this time should be different. Companies are levered. A lot of them are zombie companies, which were propped up by ZUB and QE. So all those chickens are going to come home to roost later this year. So under that scenario, I think the forward multiples can easily come down to 14, 15. And if you have a contraction in the EPS at the S&P level from 220 to say 190 odd, I mean, you're looking at sort of 3,000, 3,200 on the S&P maybe later this year, early next year. I don't really know the timing, but I do know economic history, and I've studied cycles going back 100 years. And, we don't get a deep inversion in the yield curve like this. You don't get deeply negative prints in the conference board's leading economic indicators. You don't get a tightening of the bank's lending standards and bank runs and deposit flights and everything else and have a soft landing. It has never happened in the past.
So if you're bearish right now and you think we're going to have a recession later this year, how are you positioning your portfolio? I know you obviously have some longs in your portfolio. So how much hedging have you been doing?
Well, I've been hedging on and off, trying to time the market, which is not easy, as you know. At the moment, I don't have any hedges on. I removed them last week. I was short the Russell 2000 futures as a hedge in the portfolio. I'm fully invested in my equities. And after this bounce, I expect that there is likely to be a bounce in stocks over the next few weeks, simply because the market now thinks the Fed is done and we have avoided a recession. So we may get this pause rally for the next couple of months or so before the sort of wheels come off this train. So what I'm trying to do is try and, make some money over the next few weeks on the long side. And then when I feel that, this thing has run its course, and the unemployment data, starts getting weak, and the jobs market shows signs of deterioration, then I would put back the hedges and short the Russell 2000 futures again. But, this is not a very straightforward market. It's been one of the most challenging markets I've experienced in 20 years of doing this.
So what are some growth stocks that you like right now? And why do you like them? I know growth stocks come in many flavors. Some are growing. Some might say a growth stock is growing 20, 25, 30%, positive EBITDA, barely profitable, but expanding those profit margins or net income margins, maybe free cash flow margins look better than net income margins. But what are some of the stocks you like, and why do you like them? What are some of the metrics that you look at?
Well, Jonah, I've invested in software businesses. I own shares in e-commerce companies. I own shares in payments companies. And I'm trying to, as always, look at those businesses which I feel are still early in their life cycle with a long runway ahead of them. So for me, the rate of growth is very important. So I generally try and invest in those companies which are growing rapidly and where estimates are suggesting that this growth is likely to continue for the next 3 or 4 years at least. And then I'm looking at companies, which are sticky, where there are some, network effects or some sort of a durable competitive advantage, which basically forces their customers to stay with them and not leave. And also high gross margins. I'm looking at, the operational leverage, whether companies are, trending towards profitability or they are going in the other direction. I look at stuff like free cash flow. What is the free cash flow? Generation, what is the free cash flow growth, what is the free cash flow margin for this business, what are margins likely to look like? Because at the end of the day, the only thing which matters is free cash flow per share. What the business generates in cash as owner earnings is the factor which determines the value of the business over the long run. So if companies are producing free cash flow, and if they are unprofitable on a GAAP basis right now, that doesn't bother me. All I'm interested in is free cash flow generation and what those cash flows and those margins will look like 4 or 5 years from now. So some of the companies that I've invested in In the payment space, I own shares of ADEYN, which is the Dutch payments processor, which I believe is one of the best, payments processing business out there. I own shares of Mercado Libre, which is the Latin American payments and e-commerce giant. I own shares of Shift4, which is a payments processing business in the US. I own shares of dLocal, which is a Uruguayan business which also operates in the emerging markets and helps businesses process their payments in many regions and countries. And all customers have to do is plug into one API and everything is handled for them. So in the payment space, these are the companies that interest me. In the software space, I own shares of Snowflake, CrowdStrike, Zscaler, Datadog, and Confluent. In the e-commerce space, I own shares of GLBE, which is a smallish firm which has a tie-up with Shopify, and it helps big companies sell their merchandise in cross-border and handles all the logistics, payments, and stuff for them. In the EV space, I own shares of Tesla, which, in my opinion, is the undisputed king in that space. They've got so many advantages as far as the technology is concerned. The AI, the software.
Well, just look at Lucid. Lucid just reported earnings today. They were an absolute disaster.
Yeah, Tesla is the big one here. They've just got an incredible head start.
Do people you're in Hong Kong. Are there Teslas in Hong Kong?
Yeah, I own one.
Okay.
Where I live, I would say 25% of the cars in my complex are actually Teslas.
Wow.
Teslas are very popular.
Where are they getting the ones that are being driven in Hong Kong? Are they getting imported from the Shanghai factory?
Yeah, the original ones came from the US, obviously, but the recent ones are actually manufactured in the Chinese factory in China, and then the quality is fantastic.
What are the other popular EV brands in Hong Kong?
You see the Porsche Taycan quite a lot, and you see the Kias also. Kia has got some new cars which are pretty cool, and I've seen recently some Mercedes and BMWs, EVs as well. But by a country mile, I would say Tesla is the clear winner in the EV space, at least in Hong Kong.
You own Shopify?
No, I don't. I used to be a shareholder of Shopify, but I don't own that anymore because the growth rate has come down.
Right. I haven't owned it in a year and a half for the same reason. Growth is slowing, but expenses weren't slowing with it. Expenses were going up. SBC was going up. What are your thoughts on SBC, stock-based compensation? A lot of these cloud software companies, cybersecurity, they have to compete for talent. And one way to compensate employees is with stock, but that stock can get pretty dilutive, especially as the stock price comes down. So do you have any thoughts on SBC and whether or not these companies need to be a little bit more disciplined?
Well, I think the companies will have to be more disciplined because otherwise, this market has been so severe, it's just punished any negatives in any company. So we've already seen a number of companies tighten their belts. And I personally don't really have anything, have any strong feelings against SBC simply because, as you say, talent has to be rewarded one way or another. So either the company can pay them in cash or they can pay them in equity, which ultimately, aligns their interests with the business interest, which is actually a positive for investors and shareholders. But obviously, this has to be done with constraints. You cannot dilute a company at 10% a year, every single year for the next 5 years. If it is done within reason, then I don't really have a problem with it, as long as the business is growing rapidly and the dilution can be justified by this rapid growth in the business.
So what happens if the economy looks like it's really starting to slow down? We get a negative jobs number, a negative payroll number, and then Powell comes in and starts cutting rates. Would that prevent a recession, or is the damage already done? We're starting to see all the tightening finally take effect, and it's, by then it's already too late. It doesn't matter, what sort of monetary policy they do or rate cutting they do. It's just too late.
History shows that it's always too late. And another thing I'd like to point out, historically, the first rate cut has not been the ultimate low for equities. if you go back, 80 years or 100 years, historically, this period of pause, which I just alluded to earlier, has been, the Goldilocks soft landing hopium phase, where everyone says, oh, look, everything's fine. The jobs market is strong. The Fed has achieved the, miraculous outcome. There is no landing. There is a soft landing. Everything is fine. Business as usual. So equities go back up again. Investors get excited. And then as the lags kick in of the monetary tightening, then you see the weakness. And as soon as the jobs market starts weakening, then the Fed comes in and starts slashing rates aggressively. And historically, the first rate cut has not been the best buying opportunity for stocks. In some of these bear markets in the past, stocks have fallen, 10, 15, 20, 30% after the initial rate cut. So, unless this time is different and, 100 years of history doesn't matter anymore and, everything is computerized and, we're living in a brave new world, I'm not so sure that we've seen the worst of this cycle. I may be wrong, but 100 years of history suggests that there is more pain to come.
Well, not to mention, this Fed seems very stubborn and very gung-ho on getting rid of inflation. So if they actually started cutting rates, it means things have gotten pretty bad.
Correct. And coming back to your point, I think if they start cutting rates, by that time the horse has already left the barn. It's already bolted. So you can't undo a recession or stop a recession by cutting rates. It takes time because all the tightening, the effects of the tightening have to filter through that economy. And then at some point, the easing from the Fed, again, does the reverse and revives and stimulates the economy, but with a lag. So the recession historically has not been avoided simply because the Fed has cut rates. On the contrary, the Fed rate cuts have been a sign that things are so bad that the Fed has actually had to step in and cut interest rates aggressively. And I think before the cycle ends, we're likely to see, a huge decline in the Fed funds rate. I wouldn't even be surprised if the Fed funds rate goes back down to 0 or even 1% or so.
So if that happens, you'd want to be long bonds, I assume, right?
Correct. If that happens, then, at the first sign of cutting rates by the Fed, I think that would be the time to go long 2-year treasuries or even the long bond, simply because, if we do get a hard landing in the States, then long-term rates and even the short-term rates are going to come down, as they always do with falling inflation expectations and growth expectations. So bonds would probably do quite well at some point in this cycle. And also, I think long duration stocks are likely to show relative strength. The growth stocks relative to the economically sensitive, old school, value type companies, which are in the Russell 2000.
If we have a recession in the US, do you think it drags the rest of the world into a recession as well? Or will there be pockets of the world where you can still invest in equities and do well? Like I'm just thinking like Mercado Libre, for instance, which I have a position in. It's my third or fourth largest position. I think it's fourth. They're in Latin America. They don't do any business in the US. So I'm wondering if we have a recession, is Mercado Libre sort of, will things be fine? Or, are they going to see decline in their business as well? So,
well, the business may come off a little bit, it will soften because the American, economy is just too big, it's huge. And a lot of the growth actually emanates from the US. So, of course, I think all parts of the world will be impacted to some extent. More importantly, if there is a big recession in the US, then equities may actually come down somewhat anyway, regardless of where the business operates, simply based on sentiment. Because one thing we have seen in the last several cycles is when you do have the final leg down in stocks, then everything sort of gets hit at the same time. The correlation suddenly picks up and everything gets affected to some degree. Now, having said that, there's another thing which has been racing through my mind over the last few weeks, is that the last bull market is the first bull market, at least to my knowledge, where the bull market, Jonah, ended several months before the end of QE. Like this had never happened in the past. In the past, the stock market always reacted to the changes in monetary policy after the event. So if you look at QE1, QE2, the QE3 and so forth, the stock market ended, the boom in stocks basically ended around the end of QE or several months after the end of QE. So this was the first cycle where stocks actually peaked 4 months, 5 months before the end of QE. So stocks were falling in Q1 2022 when the Fed was still doing QE, right? And the Fed hadn't started raising interest rates. So the stock market started discounting the coming changes in monetary policy several months before the actual event. Now, if you look at the price action in equities over the last few months, which I pay close attention to, some of the liquid leaders, like you said, the Apples, the Microsofts, NVIDIAs of this world, Facebook, Meta, they've already done a moonshot. If you look at the semiconductors index, the semiconductors index has also done really well. And if you look at the S&P and the NASDAQ, they've actually formed a nice consolidation pattern. And they have broken above the 40-week moving average, which is also now turned up, and it is basically pointing upwards. And the 10-week moving average has also crossed above the 40-week moving average. So the price action is suggesting that, we have seen the lows for stocks based on the price action, because in the past, we have never seen a 7-month-long bear market rally. The longest one, to my knowledge, was in 2001 to 2002. In late 2001, the market basically bottomed, I think, in September. And that rally failed in March. So that was a 6-month event. And back then, the S&P never really managed to get so far above the 40-week moving average. And the 10-week moving average didn't really decisively break above the 40-week moving average. So the price action and technicals are suggesting that perhaps we have seen the low for the indices. However, the macro and 100 years of history, economically and financial history, are suggesting that the lows lie ahead. So it's a bit of a conundrum. And I'm just beginning to wonder, perhaps just maybe, that the stock market, like it discounted the end of monetary easing 5 months before the event, perhaps the stock market this time around has also discounted, the worst several months before the Fed actually changes its policy. So it's a very tricky situation. I've never experienced anything like this in 20 years of doing this, and even studying decades of history, I've never seen this happen before. But just like the way the bull market ended several months before the end of QE, it is conceivable that the stock market perhaps has already discounted the worst before the Fed has actually started easing. Only time will tell.
Now, when you increase your hedges, are you decreasing your longs at the same time?
No, I keep my longs.
Right.
I'm invested in stocks because these stocks have already gone down so much, Jonah. They're down 70, 80, 90%. And if you look at the chart patterns on the weekly charts, they are suggesting that a number of these charts have already based out, and a number of them have already started breaking out of the stage 1 basis, and they're already in stage 2 ascents. So I'm respectful of the price action. The price action is saying that perhaps these stocks at least have discounted the worst already. So I'm not a seller of these companies at these levels. What I will do is monitor the situation closely. And if and when the unemployment figures in the US start deteriorating, that's when I will put back the hedges on by shorting the Russell 2000.
Gotcha. Do you do anything in crypto?
I don't have any positions in crypto at all.
Okay. Do you own any of the mega cap stocks? Do you have any position in Meta, Nvidia, Amazon?
No.
Mostly, like you're like a mid cap growth guy, right? Like,
yeah, I invest in younger companies because I know that these blue chip large companies can also provide some very decent returns. But you're not going to get a 10-bagger from these very easily. Whereas if you invest in companies where the market caps are a few billion, going up to 10, 15, 20 billion, then it's a lot easier to get a 5 or a 10-bagger on those companies because they're just smaller, much earlier in the life cycle, and they can grow a lot quicker, and the share prices generally appreciate a lot quicker.
And you like founder-led companies as well, right?
Yes, I do. I think it's important for me as a shareholder to see that the guy who set up the business is still involved in the business. The person, he or she, has skin in the game. They own shares of the business and they're actively involved in the business, because obviously, if they have committed their life, if this is their life's work, they're going to try very hard, especially if their financial interests are aligned with shareholders, to do the very best for the business, which is what I want to see.
When you sell a stock, why do you typically sell it? Is it fundamentals are falling apart, your investment thesis is no longer intact, valuation has gotten too stretched? Like what typically triggers a sell for you?
I mean, There are 2 or 3 reasons. One is, if the business is deteriorating, or if the management has done something wrong, or if there are changes at the management, then I don't hang around, I sell. If I spot an investment opportunity, a new company or a new IPO which is just coming to market, and I feel that the potential for growth is a lot greater than the new opportunities and I need cash, then I sell to raise cash for the new investment. And finally, and something which I will implement now going forward, is at the top of the credit cycle, instead of hedging, I will just liquidate all loans and go into cash. That's a lot easier way to preserve your wealth and preserve the gains of the bull market, and not have the headache of hedging and monitoring everything during the bust, because every boom is followed by a bust, and every bust is followed by a boom. This is not a final bust, in my opinion. It has been painful for investors over the last 2 years or so, especially the growth investors, which were hammered by the rapid increase in long-term interest rates. So I think, I believe that the tide is now turning, and at the next cycle, when things are looking wonderful, and the Fed again says, look, we are now again worried about inflation and the economy is overheating. And when the charts show me that, that the stage 2 ascents are ending and the stage 3 distribution has become, which is where stocks gyrate and become very volatile before coming back down again, at that point, I will endeavor to sell all my stocks and just go into cash for several months. So coming back to your question, when do I sell? The credit cycle top, when I need money for something interesting, and if the company's fundamentals or management deteriorates.
You think we'll see the VIX? Because the VIX has been pretty tame this year for the most part. I mean, it spiked on the Silicon Valley stuff, the bank failures. Do you think we'll see the VIX start heading higher if the markets are heading lower?
Historically, this has been the case. If you see the end phase of any bear market, we have seen a surge in the VIX. We have seen credit spreads blowing out. We've seen problems in the credit markets. We haven't seen any of that yet in this cycle, which is why I'm skeptical that we have seen the worst for the economy and the stock market. But I may be wrong. The VIX, if history is any guide, it should spike at some point, and it hasn't spiked so far, which is a bit of a mystery to me. And I know some guys on Twitter cover this VIX a lot more than I do. I'm not an expert in this area, but I would expect the VIX to also go up if we do get a hard landing in the US.
Do you own Snowflake right now?
I do own shares of Snowflake, yes.
Why do you like Snowflake?
Well, Snowflake is just a very dominant business, and it's got a fantastic management team. Frank Lupton, is one of the best executives in the software space. The business is very sticky. If you look at the net dollar-based net retention rate, it is sky high. They've got a huge total addressable market, and I believe what they're doing, which is data lakes, warehousing, and ML and so forth. This is the future, and they have competition with Databricks and some other smaller players. But if you look at the growth rates, which are just fantastic, the business is unprofitable right now on a GAAP basis, but they are profitable on an operating adjusted basis. Plus, they are also free cash flow positive. I believe that Snowflake will grow significantly over the next 10 years, and it will generate pretty healthy free cash flow margins at scale.
What are a couple stocks that you don't own right now, but are at the top of your watch list? And maybe with another good earnings report or maybe a pullback, you'd consider initiating a position?
Well, the top of the list has to be Celsius. I know it's your favorite. And you were one of the guys, the first guys to actually spot this business. So hats off to you. I have, dabbled in this stock. So I bought a few shares as a starter position, and I've tested their products. They're available here in Hong Kong because Mr. Lee Ka-shing, he owns a chunk of this business. He was one of the early investors in the company. And Lee Ka-shing also owns supermarkets here in Hong Kong. So you see Celsius getting shelf space in the supermarkets in Hong Kong. So I've tried the product. I prefer it to Red Bull and Monster because that just, is heart attack central as far as I'm concerned. And Celsius is more gentle than Red Bull and Monster. My only reservation, Jonah, there is I just don't know how sticky this offering is, because at the end of the day, this is not a software business or a payments business where customers locked in.
It's competitive, and consumer tastes are always changing. There's always a hot new product. There's energy drinks is a very competitive market. It's a very large market. I don't think people even realize that Monster has a $62 billion market cap, and Red Bull, which is a private company, if they were public, they'd probably have a $70-80 billion market cap. So huge market. But there's always, a hot new energy drink coming up. Like right now, Ghost is pretty hot, so you have to worry about, whether or not there'll be a threat to Celsius. So no, I hear that. I mean, that's a fair criticism. I think one of the reasons I remain bullish is because of the Pepsi deal. Because Pepsi is now their major distributor. Pepsi will take them international. So that should keep the growth going. But yeah, it's a valid point. I mean, there is no recurring revenue business to Celsius, except for the people like me that are, that do the auto ship on Amazon.
They should give you equity in the business just for drinking so much Celsius, John.
It's my biggest position. I mean, it pretty much has been for the last couple of years. So I'm a happy shareholder. Stock's back up above 100. They report earnings tomorrow, but by the time people are watching this, we'll probably be past the earnings report. So, okay, after Celsius, what are a couple names that are also at the top of your watch list?
I've also been following ENPH, the energy business, pretty closely. I mean, the business itself looks fantastic. They've got really high margins, very high cash flow generation. The free cash flow margin is very high. The stock has been clobbered recently because of the slowdown in the space in the US, because of the macro situation deteriorating. So that's something on my watch list also. But the forward estimates for this business basically show a sharp deterioration in growth. So that's why I'm on the sidelines and just watching this carefully and studying the business. And I already have exposure to Tesla, which is already in the energy space, although it's not the same business, but it is in the energy storage space, which gives me some exposure to this industry. So these are a couple of the businesses that I'm watching quite keenly.
So you framed the perfect conundrum, which is, I hear a lot of people say, oh, I love this company, but I would love it more if it pulled back 25, 30, 35%. The problem is if it does pull back that much, it probably means the underlying business is deteriorating and growth is slowing, and that's why the price is coming down. So, it's like a double-edged sword. Like, yeah, I mean, I've looked at ENPH as well, but, if growth is slowing, I mean, that explains why the stock has gotten clobbered. Palantir is one that's been kind of on my watch list. They reported good earnings today. Stock's up 27, 28% after hours. But until recently, I couldn't get comfortable with the valuation. But it seems like all these companies they've heard the shareholders and they're finally listening. It's time to cut costs. It's time to focus on profitable growth. The growth at any cost is, sort of that's in the past for now. Companies like Twilio, they played that game for many years, and then, that stock's still down 80% from the highs. Cloudflare is another one, that was growing very fast, but once growth starts to slow and, expenses aren't slowing with it, you have a stock that gets absolutely clobbered. Do you own Cloudflare right now?
No, I used to own shares of Cloudflare, but I sold out after the most recent ER. Simply because, I had a problem with the slowdown, and I also felt that it was irresponsible on the part of the CEO to issue such a bullish and optimistic guidance at the end of last quarter, and then do a complete sort of reversal of all of that in 3 months' time. I much prefer management which is more conservative. Like if you look at Datadog basically took the pain 3 months before. They came up, they said, look, our growth rate is going to be 25% for this year, which is roughly half of where they were last year. And I thought that was the most more sensible, responsible thing to do as the management of the business, to promise less and then over deliver.
But don't you get frustrated when the company gives they report Q4 earnings, They give their full year guidance for the next year. It's conservative guidance, but they don't really say that it's conservative guidance. So the stock gets hammered on that guidance. And then they beat and raise each of the next 4 quarters. So we look backwards and say, oh, well, yeah, that guidance they gave 12 months ago was conservative. The stock, maybe the stock shouldn't have dropped 20% on that conservative guidance, but we didn't know it was conservative. So, I mean, I get it. It's tough for a CEO and a CFO to look out 12 months and give guidance, but it does, like, I'm dealing with this with Shockwave Medical. You know, they gave very conservative guidance when they reported Q4 earnings. The stock got hammered, and then they reported today and gave a nice beat and raise. And it's like, oh, here we go again. They're going to keep beating and raising after getting conservative guidance. So
I hear you. I think, you know, for me as a shareholder, I'd rather the management gave me the worst outlook. And then at least if they do better, then at least, you know, I as a shareholder and the market is prepared and it anticipates the slowdown. Whereas a company which says, look, this is, this recession or this economic slowdown, downturn, call it whatever you want, doesn't really affect us. We will keep growing because we are, you know, the next best thing since sliced bread. And then 3 months later, you basically, you know, get egg on your face. I think that put me off a little bit. And I think some of the comments from a Cloudflare CEO, where he's saying, you know, that he's encroaching on Zscaler's business, Zscaler's done, finished, we are the leaders. And if you look at the preliminary guidance posted by Zscaler yesterday or today for you, that says a completely different story. So I just, I mean, maybe it's an unfair comment or criticism, but I just find Cloudflare CEO to be a bit too promotional for my liking. I'd rather have CEOs which actually put their head down and get the work done without, attracting too much attention and noise.
I mean, I guess after a while, you come to learn which CEOs are more conservative with their guidance than others. You know, like the next time, next year when Shockwave issues their full year guidance, we know that they're probably being conservative and they're just setting themselves up for, beat and raises throughout the year. So maybe the stock sells off less next time with conservative guidance. And when you see the stock drop like that on conservative guidance, it also gives the big funds a chance to get in. I mean, is there something to that? Like, are they trying to lure in the big funds, the funds with the big money?
I don't think so. I don't think there is any malicious or nefarious reason why companies guide down. I think any responsible management team, I would hope that would come out straight away and warn shareholders that business will be weak, because that way, the stock goes down, yes, but you come out with your credibility intact. If the company comes out and guides 50% year-over-year growth, and 3 months later the revenue growth goes down to 25%, then your stock goes down anyway, and so does your credibility. So I would rather have a CEO which is honest and credible than a CEO who is overly promotional and over promises and under delivers.
Which growth sector do you think would hold up the best in a recession?
Well, the growth sector, I think software will hold up the best. If you look at enterprise spending, some of these companies which I mentioned to you, Snowflake, CrowdStrike, Zscaler, Datadog, Confluent, businesses, Jonah, run on these companies. These are not wants, these are needs. The products that these companies offer, the software that they offer, they are not discretionary spending by these companies. A lot of these companies depend on these offerings by these companies to run their business. And if there is a recession, I don't think any big enterprise is going to say, well, hang on, there is a recession coming. We don't need Zscaler, we don't need CrowdStrike, we don't need cybersecurity. Let's just stop paying our bills and we'll just live without cybersecurity for the next 6 or 9 months. That's not going to happen. Similarly, software observability and so forth, which is application observability and monitoring, which is what Datadog provides. Companies are not going to say, well, we're not going to suddenly stop. We're going to suddenly stop, monitoring our tech stack because there is a recession. So, you have recurring revenues. These big enterprises are locked into these contracts. I mean, some of them are usage-based, but a number of them are, seat-based, fixed subscriptions. So I think this sector is going to prove to be quite resilient. The growth rates may come down in a severe hard landing, but I don't think the revenue is going to go down. And I still think that a lot of these companies will continue to grow. In my opinion, these companies are like modern day utilities on steroids, simply because big companies need them. And they also, unlike utilities, provide a significant and rapid growth for a long period of time. And they are very high. They have very high gross margins. So if you look at the gross margins of some of these companies, they are 70, 80, 85%. And they are GAAP unprofitable now on a GAAP basis, simply because they are spending a lot of money on S&M, sales and marketing to keep their growth growing. And they're trying to grab as many customers as they possibly can, whilst they can, because they know that these customers that are then locked in for a long period of time. And the customer acquisition cost is tiny compared to what they generate over the lifetime of the customer. So these companies are basically unprofitable by design. They're not unprofitable because they are just a bad business. Far from it. They're capital-light businesses with sticky customers, recurring revenues, and mission-critical offerings. So I think that software will probably be a big winner in an economic downturn, simply because those stocks have been hammered already. If you look at the valuations, Jonah, as you mentioned earlier, the valuations are now very attractive compared to where they were 2 years ago. And I've been putting out a chart occasionally on my Twitter feed, which shows the valuations of these software businesses going back 10 years. So the valuations today are now the lows of the last 10 years. I'm not saying that they can't go any lower, but I think if you're paying 6 or 7 times forward EV for 2023 revenue for a company like CrowdStrike, or 7 or 8 times for Datadog and Zscaler, I would argue that those are pretty attractive valuations if you have a long-term mindset.
You ever short individual stocks, or is it typically just the indexes, the futures?
I mean, I have gone short individual stocks in the past, but I just don't bother with it anymore because, as a guy who's been doing this for 20 years, I've realized you make your money going long growth stocks. That's where I've at least made the bulk of my money in my career. Shorting works occasionally, but if you short, that is a bad risk reward, especially on a company level, because the maximum you can make is 100%. And the maximum you can lose is, thousands.
Right.
Yeah, so you could possibly lose if you're not disciplined. You could get wiped out. So shorting individual names is not something I would recommend to anybody. I just think, you're playing with fire. And the way the world is set up, with population growth and, the growth in productivity, innovation, and the best minds in the business in the world, powering these companies and creating value for shareholders, and increasing revenues, cash flows, earnings over time, shorting is a mug's game, in my opinion, unless you spot an extremely overvalued, lousy business, which can come off 50, 60, 70, 80%. But I would much rather own companies with a long-term mindset and make, hundreds and thousands of percent with lower risk than shorting individual names, in size and frequency.
So if you had to, say you had to hold, over the next 5 years, you could either own SPY, QQQ, IWM, or ARKK. Which one do you own for the next 5 years?
Oh, that's a tough one.
From current prices.
I would still own the NASDAQ 100 QQQ. I think the QQQ will probably do better than most.
And would you go with the market cap weighted QQQ or go with QQQE, which is the equal weighted?
I would still go with the QQQ because I think that these big tech giants, the Megacaps, are fantastic businesses, and it's not going to be very easy to disrupt them over the next few years.
So last question. I know you don't own the Megacaps right now, but I mean, they're obviously phenomenal businesses. No one can argue that. Would you like them more if they got broken up? Meaning if you could own different pieces of Amazon or different pieces of Meta, different pieces of Microsoft and Google, would you like that as an investor?
I think it depends on the business, Jonah. If you break up AWS from the e-commerce business, I don't think that will actually hurt the business that much. If you own AWS as a standalone business, that would actually be, that would actually create value, because I think the value of that business will go up simply because of the growth rates and all the qualities I described earlier, and the valuation would shoot up as a standalone software infrastructure business. If you separate Alphabet or Google, I'm not so sure if it's going to work. If you separate YouTube from search,
right,
or the advertising, I think all these parts together for Alphabet actually make it a stronger company, because if you have the sum of all parts, I think here is more strong than all these pieces broken out.
Right. They're right. Search and YouTube, they're all very intertwined with each other.
Exactly.
It would be very difficult to break up some of these businesses. I agree. I just, I would love to own YouTube by itself, or I'd love to own Amazon by itself, or AWS, but it'll probably never happen unless they get so big, that there's just too much pressure on Congress. But I think that's years away. I don't see it happening anytime soon. It's interesting. Like, Alibaba is, they've announced that they might split up into 6 different businesses, and it makes you wonder, what companies in the US would ever follow that path. But I don't think any of them would ever do it. What's the right word? Without being forced into it.
I agree. I think if the regulators force them, then they would be forced to break up. I think the Alibaba splits in different business divisions is also politically charged. I don't think Jack Ma wanted to do that on his own accord. I think he was given instructions to some degree by the powers to split the business, or maybe he did it himself to try and create value individually, which I doubt.
No, he was probably forced.
Yeah, I don't know any businessman who would basically be happy to split the company in 6 different parts if they don't have to. So I think if there is political pressure, or the regulators force these tech companies in the US to split their businesses in different divisions for anti-monopoly rules and laws and whatever, that's different. But it's a very difficult question to answer, because every company has its own nuance. Every company has different characteristics. So it's hard for me to say, well, whether splitting the company in smaller pieces will be good or bad for all the companies across the board.
It's an exercise on, what is the sum of the parts worth, but, as long as it's trading together, you'll never really know. People joke around that, when you buy Amazon, you're buying AWS and then you're getting the retail business for free. Or, when Meta was at the lows in October, you were buying Facebook and getting Instagram for free. But you never really know until these things spin out, and, that's not going to happen. That's a pipe dream. So any parting words for us, Puru?
No, I just think, the last 15, 18 months have been very difficult for, anybody who has been involved in the growth space. Stocks have been hammered, not just bad companies, decent companies have been taken to the woodshed with 70, 80, 90% declines, which don't happen very often. They've happened maybe 3 times in the past, in 1929, in 1974, and also in 2000, and during the tech bust, where stocks fell 70, 80%, and then they bottomed, and then some of the good ones went up thousands of percent. So I would just say, if you are a long-term investor, this is a fertile ground for picking up shares of amazing businesses, world-changing businesses on the cheap. The next few months, 6, 9 months, may be rough and choppy, but I think this bear market now is at the same stage where it was towards the end of the TMT bust. And those who had the fortitude and the courage to go against the prevailing negative sentiment back then and bought shares of Amazon, Microsoft, Netflix, Monster Energy, and everything else, Adobe, Salesforce, they made an absolute fortune over the next 10, 12, 15 years. So I think this bust is not going to go down as any different in the history books. This will turn around, and those who invest in amazing companies, as always, will be rewarded handsomely.
So here's a couple last questions. I'll do quick fire. I know this is going to put you on the spot, but we'll have some fun with it. For the next 3 to 5 years, if you could own Netflix or Disney, who would you pick?
I would still pick Netflix.
Yeah, I would too. And if you could own Amazon or Shopify for the next 3 to 5 years, who would you own?
That's a harder one. If you look at the valuation of Amazon, I just think it's dirt cheap. And Amazon is a fantastic business. Shopify has already had a decent run off the lows. It's more than doubled. So if you put a gun to my head, simply based on the valuation and the expected returns over the next 3-4 years, I would go with Amazon in this case. Not because I don't like Shopify. I just think Amazon's valuation at this level is significantly cheap than its value.
Do you own Amazon yet?
I don't own shares of Amazon.
But have you thought about starting a position?
No, I mean, as I mentioned, I invest in companies with higher revenue growth, and younger companies. I mean, if I was looking at mature businesses, definitely I would be buying shares of Amazon and Alphabet at these levels, because I think these companies are durable. They're going to be a lot higher a few years from now. But, I play in the other end of the spectrum where the market caps are a lot smaller and the growth rates are a lot larger. So that's why I've not really invested in these companies myself.
And last question, if TikTok was a publicly traded company, would you want to own TikTok?
I mean, I would have to look at its business, I would have to look at the growth rates, the margins, the path towards profitability and so forth. But I think there is a lot of geopolitical risk involved there.
Right,
You
right.
never know if nations or regions start banning TikTok. So, it comes with the caveat, of the extra risk involved in a Chinese business or a business which is associated with China.
It'll be interesting. I mean, as we start getting closer to the elections next year, presidential election, what sort of rhetoric do we hear coming out of these campaigns, and who's running on the idea of banning TikTok in the US and, protecting our data, protecting our kids and all of that stuff. So I don't think that ban TikTok. I don't think that debate or, that's going to be even a hotter topic over the next 12 to 18 months. So
possibly, yeah. I mean, the thing is also, if you look at changing subjects a little bit, if you look at the sentiment now, people say the stock market is efficient. Well, I don't think it is efficient at all, because if you look at 2021, we had this insane bubble in tech. These forward multiples went up to 30, 34, 50, 60 times revenue.
Right.
And everybody was then saying, oh, look, the market has become efficient. It is now realizing how wonderful these businesses are. Well, that was the wrong view, right? And now when the multiples have come down to 10-year lows, when, the EV multiples are now 6, 7, and 8, and when SOFI is selling at 80% of book value, now the pendulum has swung to the other extreme. So back then, everybody wanted a piece of those businesses when they were trading at such rich multiples. And now, FinTwit likes to call these companies shitcos. People say, oh, your portfolio is a bunch of shitcos. Just because the stock is down 70, 80%.
Right. Doesn't mean, right. Well, I mean, look at Meta. Nobody wanted Meta 6 months ago at, under $100. Now everybody wants it above $200.
Exactly.
It's amazing how fast sentiment can change as a stock price moves higher.
Exactly. I mean, if you look at SOFI, for example, Anthony Noto, the CEO, has been putting his own money to work and buying shares of SOFI in the open market. Just announced excellent operating results. A huge increase in the deposit base. Deposits are 10 billion, 40% revenue growth. They've basically guided for strong growth for this year. They've said they're going to become GAAP profitable and free cash flow positive also at some point. CEO is basically voting with his own money and buying shares. And what does the stock market do? The efficient market, it basically sells SOFI 20% simply because they purposely didn't ship some of their loans because they're collecting a decent interest on those loans. And the CFO mentioned during the earnings call that the reason why they haven't shifted is because they're trying to optimize the best way to maximize the return on equity. And it's not a problem. They've got $8.5 billion of warehousing facility, and only 3.5 is actually used up at the moment. But the market ignored it and basically just crushed the stock by 20% because all the other regional bank stocks were going down. So, this market is basically an insane mob. It's an emotional mob. And those who basically, get their guidance from stock prices generally don't do very well,
Or analysts.
Yeah. I mean, if you use the logic that, the stock is amazing because the stock is going higher, that's a really crazy reason to invest. Because if all these stocks were going higher in late 2021, when the valuations were 35, 40, 50 times revenue, and then they plunged 70 or 80%. And similarly now, these stocks are trading sideways, they're treading water, or they've been making new lows, and the valuations are so cheap. And people on FinTwit are saying, well, these companies are shit because their stocks are going down. This is exactly the time when you should be buying, when valuations are compressed and these stocks are hated, and when business is still not at its best, because by the time business turns and the growth rates come back up again and the economy is out of the woods, then these stocks will be 100% higher. So, you have to go against the grain. You have to, sell euphoria and buy the fear.
But that retail likes to do the opposite. They like to buy into the euphoria. They'll be plowing into these stocks right before right at the top, right before the recession starts. Everything looks great. They're going to be loading up on these growth stocks rather than buying them 6 months later when they were 50% cheaper. So,
another example, LILM. I post, just out of interest of disclosure, I post my holdings on my Twitter page as a pin tweet. So, whenever I comment about any company or whatever, at least people know that, whether I have any vested interest or not, I just think that's the responsible thing to do. So, when I posted my recent holdings, some followers said, oh, you own LILM, that company's bankrupt, you're going to go broke, you are an idiot, blah, blah, blah. 2 days later, LILM announces that they've got $100 million funding from Tencent, which is its largest shareholder. And Tencent has promised another 75 million if they can raise another 75 million from somewhere else. And the stock has basically tripled from the lows since those hate comments were coming.
What does LILM do? I'm not familiar with the company.
LILM is basically an eVTOL business. They're developing an eVTOL, which is
which is like vertical takeoff.
Yeah. So they're basically in the process of launching air taxis, electric air taxis, which would basically take people from A to B.
Where do they operate in? If Tencent's an investor, I'm assuming they're in Asia, right?
No. It's a German business. And the management team is actually ex-Airbus, Rolls-Royce, and Honeywell. The ex-CEO of Airbus is the chairman of the board. One of the senior executives from Airbus, Klaus Rowe, he basically joined LILM last year as the CEO of LILM. And some of the other management team is also fantastic, from Rolls-Royce with Honeywell and so forth. They've got partnerships with a lot of the big companies, and a lot of the big companies have invested in LILM. So LILM is now developing an eVTOL, which will be certified by 2025 or late 24-25. And they hope to commence commercial operations by 25-26 onwards. And they have plans to actually launch their service in Florida, in the US, and also in Europe. The market cap right now is pretty low. If you look at the valuation with the recent fundraise, you're looking at a market cap of around 500 million US. If you look at Joby Aviation, that is significantly greater. And I would argue that, LILM's design is really cool when compared to
where would these companies operate? Are they targeting dense metropolitan areas where they're taking people from rooftop to rooftop, or is it going from like the city to the suburbs, taking rich people home?
LILM has two plans. One is that they're going to have this ride-hailing taxi, sort of air taxi service, where they take people from airports to certain areas in the city. So they're going to cover sort of 100, 200 Ks range. So if you want to go to the airport, for example, or if you want to go somewhere else, then you could hop onto this thing and avoid the traffic.
So they're kind of competing with helicopters at that point, right?
Correct. Yeah, correct. And the advantages here, of course, there's no pollution. It's electric. They have also announced recently a tie-up with NetJets. So NetJets has said, subject to them meeting certain performance criteria, if everything is fine with the aircraft, NetJets has already said that they're going to buy some vehicles from them. They are also going to start selling these vehicles to companies and also rich individuals as their own private sort of eVTOLs to go around. So it's an exciting business. It's at the forefront of an exciting new industry. There is competition. There's Joby Aviation. Some other companies are also involved, but I'm just taking my chances here simply because of the strength of the management team and the people involved in the business and the investors' quality.
I'm assuming it's one of your smaller positions, right?
It is, yeah, it is a smaller position. It's just 3%, 3.5% of my portfolio. So, even if everything goes wrong and the company goes bankrupt, it's not going to bankrupt me. It's just 3% of the position. But, I just find it interesting that the sentiment now towards any of these high growth companies is so negative that, people are just, post hateful comments and criticisms the minute you even mention that you own shares of these companies, and that to me says that we are probably scraping the lows. Yeah,
I mean, there's a few that I'm looking at that, former SPACs that came public at $10, shot up to $15. Now they're trading at $1 or $2, and they have a real business. They're not profitable yet. Cash burn is coming down. They have enough cash to last another 18 to 24 months. I mean, there's some interesting businesses in there that have just been absolutely slaughtered that could be, could have some upside over the next few years. But like you said, I mean, as soon as you post about them online, it attracts all the trolls. So I post less on Twitter now than I ever have before because it's just not worth it. Right. I mean, you can't really voice your opinion without, bringing in some negative sentiment or negative haters. So it is what it is. I mean, I appreciate what you do. I think we're all thankful that you still post your portfolio. You're very transparent. You share your thoughts, regardless of the criticism that you may or may not get. So, at some point you just have to keep doing what you want to do and drown out the haters. So,
no, I mean, haters don't bother me. If somebody leaves funny criticisms, it doesn't bother me. If people are extremely rude and disrespectful and they just are trolling clearly, I just block them pretty quickly.
Good. Me too. Yeah, I've blocked a lot of people. Well, Puru, thank you so much, man. Really appreciate it. As you can see, it's getting kind of dark here, so I look like a ghost right now on the screen. Well, thank you very much. Look
Thank
forward
you very much, Jonah. It's a pleasure to always have a chat with you, and we'll do it again sometime soon.
Okay, sounds good, man. I'll talk to you soon.
Yep, take care. Thank you. Bye-bye. Thanks very much. Bye.